Canadian Tire is exhibiting classic signs of strain. As a brick and mortar retailer with poorly positioned in an e-commerce world and a mobile world, we think that Canadian Tire just doesn't stack up well. When we look at retailing, we look at the few P's: the price, the product, the placement, the promotion. We don't believe Canadian Tire is price competitive. We think that they're lagging in their social media marketing presence. We think a lot of the locations are very close to some dominant U.S. retailers, whether it be Walmart, Costco, Home Depot, or Lowe's. And finally, in a world where consumers are expecting free shipping, Canadian Tire does not offer that. So structurally, we see some issues there. And then secondarily, we have a concern with the balance sheet. The leverage has been rising. We think the company has been misdirecting capital towards share repurchase and increasing dividends. Now, companies increase dividends in good times, but what we found is that out of 6 of the last 7 quarters, Canadian Tire has missed their sales estimates, and last quarter produced 0 revenue growth. So this is not a time where shareholders should be rewarded. In fact, we think they should deal with their $11 billion ballooning debt load and prioritize debt repayment.
Now, apart from that very specific concern about Canadian Tire, you said in their balance sheet, all the other macro themes, the Amazons of the world, the U.S. competitors coming into the Canadian market, that can almost apply to any Canadian retailer. What makes Canadian Tire more vulnerable than the others? Are they all vulnerable?
Well, I think they're all vulnerable. I mean, retailing is changing. The Canadian Tire in particular, we think, has been slow to adapt. The company cited their great, 500,000 mobile app users. But what they didn't say is that that number has not been growing. And in fact, more mobile users have been adopting, Amazon's app over there. So we just think they're late to the game here, slow to adapt. The company just put through a $200 million cost restructuring program. We think that's purposely nebulous. Company did not cite specifics other than saying they had, quote, hundreds of opportunities without going into details. We think investors, have irrationally bid up the stock, discounting perfection of that cost cutting. We have some concerns about the executives overseeing that. For example, the company still has not named a replacement CFO, and the individual head of IT and supply chain, we believe he had a failed tenure in turning around BlackBerry and Celestica. So we do think investors need to take a pause here and really consider the risk-reward of owning Canadian Tire.
Now, a pause would be one thing, but to have a short call on a name, how big is your short position right now on Canadian Tire?
So by Securities and Exchange regulation, we're prohibited from discussing our private fund. In addition, my compliance officer would prohibit me from discussing our position size or our trading. So I cannot disclose that. We are short. We have laid out the reasons why we are short, and we have yet to see any rebuttal from management or the analyst community in terms of where we're wrong. We pose one question to the community right now. What is Canadian Tire's true debt load? How much debt do they have, and how are they going to get out of this debt situation, particularly if sales start to decline and cash flow starts to decline? They have no excess capital to delever right now, and that's a real concern. This reminds us a lot of our short call with Maxar. About a year and a half ago, we put a short call in the stock at the 60s, laying out many of the same claims that sales were about to slow, the debt burden was a focus, and the dividend should not be the priority. And in fact, shares fell all the way to $2 and the dividend was cut. Now, we could see a similar scenario here in Canadian Tire, not imminently, but as this is a slow melting ice cube, we really could be in a situation here where investors are trying to get a couple, percentage points of yield for a dividend, but left holding a stock that's materially impaired.
Now, did you reach out? You said since you've had your report out, you haven't had a chance to talk with Canadian Tire and their executives and their management. Before you put the report out, did you approach them and say, I want to discuss some concerns I have about the business?
We didn't speak with them directly. We review all their public filings at SEDAR. We've read and reviewed all of their statements they've made publicly. We derive all of our insights from that, plus additional research that we do. We did offer management the opportunity to come on to BNN to talk with us directly on Twitter at sprucepointcap.com. We even offered them the ability for us to make a donation to a charity of their choice if they could come and refute any of our claims. It looks like they've declined. So we're still waiting to see how are they going to deal with this debt load? How are they going to deal with the slowing sales? And really explain to investors why they should be holding on to the stock here.
Is the company a bit of a disadvantage? I mean, when I think of all the regulations, the rules, the restrictions they have on being able to speak about certain parts of what you're alleging. I mean, it seems to me when someone goes short, they have a lot more license, I guess, to make allegations or to raise concerns, and the company a little bit constrained by the reporting requirements as to how they can respond. More in general, not just this story, but more in general.
Well, I don't believe that to be the case. I mean, we put out the report yesterday. That's a full 24 hours. Most of our concerns, again, are very simple. Like, how are they going to maintain structural competitiveness, number one? And number two, how are they going to deal with the debt load? And why are they prioritizing share repurchases and increasing the dividend over meeting some of their debt objectives? Let's not forget the credit rating agencies that rate the company expect them to delever, but per our math, they have no ability to do that. So these are very simple claims that the management could have come out with a press release or a little presentation or some clarifying points as to where we're missing the story here. But instead, they issued a rather blanket response saying that we're inaccurate and that we should just dismiss Spruce Point. I think investors will be foolhardy to do that. We'll let the facts speak for themselves, and if we're right, we will see Canadian Tire's share price go down.
Now, we haven't talked about the credit business yet. I know you have concerns about that. Other people who are not bullish on the name have concerns about the credit business as well. Canadian Tire considers that one of their pillars of strength. What concern do you have with that?
Well, this is a story I've seen play out many times. I mean, issuing credit to customers per se is not a bad thing. But what we've found per our research is that they've been extending credit to riskier and riskier Canadian consumers to buy and offering greater incentives through their point reward program to get them to shop. And, even with this, again, they posted zero revenue growth last quarter, and the revenue growth has been coming down quarter after quarter, and they've been missing, what we would consider very modest expectations from the Bay Street analysts. They've missed the consensus 6 out of 7 quarters. So it's really the extension of the credit. The limitations they have there. This is not a new phenomenon. They've been extending credit for a while now, but now it's getting to the riskier and riskier customer base, and at some point something's got to give here. So we do think that every credit-led bull market leads to a bear market, and we're getting closer to the end of the cycle here.
Now, the company has pointed out in the past during investor presentations that when we go back to the great financial crisis, which we're 10 years beyond right now, that relative to the big banks, even though their write-offs at Canadian Tire through the credit business went up 20%, the big banks went up 50%. So they lean on that and they say, well, listen, we know that we have a different kind of customer who is borrowing, but in bad times, at least the worst time that any of us can remember in the past decade, they fared better than the big banks.
Sure. Well, again, history doesn't always repeat. Not always is history the best guide for the future. But again, this cycle is going to be different from the last cycle. In particular, this cycle, we think the pressures have intensified, on the core business. And that, again, we keep coming back to the fact that we think the market is fundamentally missing the displacement effect that Amazon's having. And we can see it in data that we have. We can see it, by doing price checks. We can see it by how Amazon has announced intentions to expand further in Canada with greater distribution effort. This cycle is going to be very different from last cycle because the competitive space is worse. The extension of the credit to the lower quality customers worse. And so this combination, and the debt's more, right? So you throw all these factors into the mix, and we just think that investors should brace for more downside this cycle than the previous cycle.
On the credit business as well, I mean, this would apply, I imagine, to Canadian Tire, but I have a lot of discussions about people saying when you think about a retailer offering credit, it's not just about the credit business itself, but it's about the data that they get from having that credit product out there and better being able to tailor to their customers. Is there value in the credit business just beyond the simple transaction of extending someone credit and collecting interest on that credit?
I mean, look, there's some potential value, but again, we don't think it's translated into any current upside for investors. I keep coming back to the point where they've disappointed expectations on revenues multiple times, and they've produced zero revenue growth last quarter. And, we think to maintain competitiveness, they're going to have to cut margins, become more, friendly with their shipping options. So, you get as much data as you want from credit card transactions, but if it's not allowing you to grow your business and your bottom line as well, that's a problem. And we didn't really talk about yet the accounting distortions we have laid out in our report as to why we think the earnings aren't really, the quality of the earnings aren't as good as they should be. And in fact, we don't think the earnings are growing along with the revenue not growing. Their normalized earnings adjustments might lead you to believe that they're growing low double digits, but it's the accounting strain, as well, and the totality of the picture that we think people are missing here.
I think it was a little over a year and a half ago that IFRS 9 is what we're talking about here, and that Canadian Tire had to switch over. Is that a bit of an unfair comparison, I guess? I mean, companies were beholden to switch and had to make the switch, and of course the comparisons are going to get a bit skewed because of that.
Well, that's just one, point. We saw Canadian Tire change their depreciation expectations for their assets, and this is a classic. As short sellers have done a lot of forensic review of companies, this is a classic sign when a company changes its depreciation schedule to boost earnings of a company under stress. And bear in mind, their assets did not change. All that changed was their expectation of how long they think their assets are going to last. So we see that sort of strain. And then another point we need to touch on is the strain we've seen in the acquisitions they've made. They bought Helly Hansen and the Party City Canada, paying pretty rich multiples to buy fairly developed assets. When we see the accounting changes, when we see stretched acquisitions, more leverage, it's the totality of the picture that makes us a little bit bearish on the outlook here.
Lastly, I want to ask you, and this has nothing to do with Canadian Tire, if you're looking north over the border for short opportunities, companies you think are under pressure, have you taken a look at the marijuana sector, some of the big names here in Canada?
Full disclosure, I'm not a marijuana user, so I have no view on the marijuana industry. It's not something that interests me. I know there's a lot of smarter people out there, looking at that space. Clearly, from afar, we've noticed some, a lot of new companies pop up with unproven business models and a lot of froth in the valuation. So certainly, I think investors are wise to look carefully, at that space for potential short opportunities. But because of our lack of interest and lack of experience researching that, we have no particular views yet on any individual securities in the Canadian marijuana industry.